Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today, we're doing a deep dive into, well, a global financial system that is basically fracturing right in front of us. I mean, imagine waking up and finding out that 10 million barrels of global oil have just, vanished from the map in a single month.
Right, just completely gone.
Yes, sending total shockwaves through the physical market. And then, at the exact same time, China is quietly posting these massive, like 25% stock gains in specific sectors. But everyday American investors are just completely missing out because they're looking in the wrong place.
It really is a massive paradigm shift because if you just read the daily headlines, you see all this panic about oil prices and, doom and gloom about the Asian markets. But when you look at the raw data, a completely different narrative emerges. We are basically seeing the old unified global economy break apart into these isolated regional systems.
Exactly. And our mission for this deep dive is to take that fragmentation and translate it into plain, actionable insights for you. We need to look past all that noise and understand the actual mechanics of what's happening. So let's start with the physical splintering of the market, which takes us to the Middle East. On April 28th, 2026, the United Arab Emirates dropped a total geopolitical bombshell.
They really did.
They announced they're leaving OPEC and the broader OPEC Plus alliance, the expanded group that includes Russia, and that's effective immediately on May 1st.
Okay, let's unpack this. I
Yeah.
think we need a good analogy here.
Yeah, that helps.
Imagine sharing a house with a roommate,
Mm.
right? And this roommate insists on keeping the thermostat at like 80 degrees because they get cold.
Yeah.
But you just bought this brand new super expensive AC unit and you want to use it. Why is the UAE just walking away after nearly 60 years of partnership? Well, this is a monumental shift, right? OPEC has essentially dictated global oil prices for 6 decades.
Mm.
But to understand why the UAE is walking away right now, we have to look past the political theater. We have to examine the hard mechanics of oil production capacity.
Right, because the typical narrative you hear on the news is that they just had a political falling out with Saudi Arabia.
Exactly. But looking at the data, this looks much more like a fundamental business dispute over stranded assets. Over the last decade, the UAE has spent billions of dollars physically expanding their oil infrastructure. We're talking about massive investments in offshore rigs, new pipeline networks, and terminal
You
expansions.
really built it up.
Oh, massively. They built a machine capable of pumping out 4.85 million barrels a day back in 2024. And they have the infrastructure to push it to nearly 5 million right now.
But because they were part of OPEC, they weren't allowed to use it, right? Saudi Arabia, who largely sets the rules for the cartel, capped the UAE's quota at around 3.5 million barrels a day.
Right. Which means the UAE has essentially 1.5 million barrels of daily capacity, sitting completely idle, just doing nothing.
Wow. Let me play devil's advocate here, though. If I'm looking at this as an investor, my gut reaction is, well, why risk it? If the UAE leaves the cartel and just floods the market with that extra 1.5 million barrels, aren't they risking a massive price war?
Yeah, that's the big fear.
I mean, we saw oil prices literally crash during the pandemic when supply outpaced demand. Why break the partnership if it means tanking the value of your own product?
And see, that is the exact argument Saudi Arabia has been making for years. But what's fascinating here is it all comes down to the concept of a break-even price.
Yeah.
Saudi Arabia and the UAE have fundamentally different national business models.
How so?
Well, Saudi Arabia is heavily reliant on oil revenue to fund their government. They're building these massive multi-trillion-dollar infrastructure projects like their Vision 2030 initiatives, which require oil to stay around $80 or $90 a barrel just to balance their national checkbook. They need high margins.
So Saudi Arabia is like a boutique store that needs to sell a few items at a massive markup just to pay the rent.
Precisely. That's exactly it. But the UAE's economy is drastically different. By early 2025, data shows that over 77% of the UAE's real GDP actually came from non-oil sectors.
Wow, 77%.
Yeah. They have built a highly diversified economy around tourism, global finance, logistics, real estate. Because they aren't relying solely on crude to keep the lights on, their break-even price is significantly lower. They can survive and even thrive if oil drops to $50 or $60 a barrel, as long as they're selling a massive volume of it.
Okay, that makes total sense. They want to transition from a low-volume, high-margin model to a high-volume, low-margin model. They want to monetize those stranded assets right now before the global transition to renewable energy really accelerates.
Exactly. The UAE sees the writing on the wall. They want to pump every drop they can while they still can. They are prioritizing sheer market share over price protection.
But here is the massive disconnect that I think is confusing a lot of people right now. If I'm an everyday American listening to this deep dive, I'm thinking, great. The UAE is leaving OPEC, supply is going to surge, so the price of gas down the street is going to drop.
Right, that's the logical leap.
But I'm looking at the market right now, and Brent crude, the global benchmark for oil, just surged past $118 a barrel. If the UAE is turning on the taps, why are we paying a premium?
Because right now, the global market doesn't care about production quotas. It is entirely focused on physical shipping lanes. It does not matter if the UAE pumps 5 million barrels out of the sand if they cannot physically put that oil on a tanker and navigate it through the ocean. We have to separate the paper market of oil futures from the physical market of actual barrels.
And the physical market is currently in a state of absolute chaos.
Complete chaos. Recent data from the International Energy Agency paints a stunning picture. Due to the ongoing war with Iran and the resulting blockades in the Strait of Hormuz, global oil supply dropped by a staggering 10.1 million barrels per day in March alone.
To put that in perspective for you listening, the world consumes roughly 100 million barrels of oil a day. Losing 10 million barrels overnight is a 10% wipeout of global supply.
It's massive.
But that isn't a dip,
Yeah.
that is a catastrophic structural failure.
It is literally the largest supply disruption in history. The Strait of Hormuz is essentially the vital artery of the global energy grid. Before the conflict, over 20 million barrels a day flowed through that narrow waterway. By early April, that volume had plummeted to just 3.8 million barrels a day.
How does that actually work mechanically? I mean, are ships just physically blocked by military vessels, or is there an economic mechanism stopping them?
It's a combination, but the primary mechanism is insurance.
Mhm.
Oil tankers are multi-million-dollar assets carrying hundreds of millions of dollars in cargo. They require maritime insurance to sail. When a waterway becomes an active war zone, maritime insurance premiums skyrocket sometimes by thousands of percent, or insurers simply refuse to cover the vessels at all. If a ship isn't insured, the shipping company will not let it sail. So the oil just sits in storage tanks on the coast, completely trapped.
And that physical reality is violently colliding with domestic politics here in the U.S. We actually saw President Trump meet with U.S. oil executives on April 29 to discuss these prolonged port blockades. Obviously, expensive gas is a massive domestic issue for Americans.
Absolutely.
And some analysts are looking at that meeting and framing the UAE's exit from OPEC as a direct U.S. diplomatic victory. The idea that American pressure finally broke the cartel.
Well, while it's true that any structural increase in global supply eventually benefits the U.S. consumer, analyzing this solely through the lens of American politics misses the reality on the ground in the Middle East. Based on recent geopolitical analysis, the UAE's decision is fundamentally about Gulf state survival. Yes, the maritime blockades have completely altered their risk calculus. The UAE realizes they can no longer tie their economic destiny to a regional alliance that is vulnerable to blockades. They are prioritizing strategic autonomy over everything else.
So if I'm looking at my 401k right now, or maybe I hold some energy sector ETFs, how should I process this? How do we separate the immediate panic from the long-term trend?
You really need to divide your strategy into two distinct timelines. For the next 1 to 3 months, we are living entirely in the war premium era. Prices are being driven by physical shortages, rerouted tankers, and massive insurance costs. That is why oil is sitting at $118. Short-term energy stocks and refining companies are pricing in this acute bottleneck.
But that bottleneck won't last forever.
Exactly. And that brings us to the second timeline. If you look ahead to 2027, the structural reality takes over. Eventually, the conflict will cool, insurers will step back in, and those shipping lanes will reopen. When they do, the market is suddenly going to realize that OPEC no longer has the power to restrict supply.
Wow, okay.
If the UAE is freely pumping 5 million barrels a day, other nations will likely follow suit to protect their own market share. The cartel's grip is broken. That introduces massive structural downward pressure on long-term oil prices. As an investor, you just cannot assume today's $118 oil is the permanent new normal.
That perfectly illustrates the physical fragmentation we are seeing in the global system, but the financial fragmentation is just as fascinating, and that takes us to Asia. Here's where it gets really interesting.
Oh, definitely.
While the West is currently being rattled by these massive energy shocks, China is uniquely insulated. They have built up enormous strategic petroleum reserves, and they heavily rely on a domestic mix of coal, renewables, and a massive electric vehicle infrastructure.
They've engineered their economy to be far less vulnerable to a sudden spike in crude oil.
Yet, if you turn on the financial news or read standard market commentary, the narrative is that China's stock market is an absolute disaster. It's constantly labeled as uninvestable. But let's look at the hard data for a second.
Let's do it.
In the first quarter of 2026, China's GDP grew by 5.2%. Industrial profits surged by 15.5%. Moody's even upgraded their credit outlook to stable. How can an economy be growing at 5% while its stock market is universally panned as a failure? Help me make sense of that disconnect.
Right, so the disconnect exists because foreign investors and the Chinese government are focusing on two completely different markets. When an American fund manager complains that the Chinese market is terrible, they are almost exclusively talking about the offshore tech stocks.
Okay, the offshore stocks.
Yeah. These are the companies listed in Hong Kong or New York, tracked by indices like the Hang Seng Tech Index. These are the consumer internet platforms that foreign capital is allowed to easily access. And yes, over the past year, that specific index is down 0.9%.
Oh, so it's essentially flat to negative.
Exactly. But if you look at the onshore market, the companies trading in mainland China on exchanges in Shanghai or Shenzhen, tracked by the CSI 300 index, it's a completely different universe. That index, which tracks the largest domestic mainland companies, is actually up 25.8% over the same period.
Wait, up 25.8%?
Yeah, nearly 26%.
That is a massive bull run that most everyday investors are completely blind to. It's like buying a variety pack of chips where you only want the tech flavor, but the government is only filling the bags with manufacturing and state-owned banks.
That's a great way to put it.
So explain this difference in earnings quality between the US and China. Why is our market acting so differently?
It all comes down to earnings quality and the fundamental architecture of the two economies. In the U.S., our stock market is currently hyper-concentrated. The S&P 500 is essentially being carried by the information technology sector, fueled by the artificial intelligence boom. We are looking at projected EPS earnings per share growth of nearly 44% in American tech alone.
Right, our market is basically built on software, cloud computing, and AI hype.
But Beijing's policy priorities are entirely different. They are directing state capital through massive state-owned banks into manufacturing resilience, domestic supply chains, and energy security.
So it's policy-driven.
Highly policy-driven. They are giving preferential loans to battery manufacturers and industrial engineering firms. The Chinese government has zero interest in propping up social media platforms or e-commerce algorithms just to make the offshore stock market look attractive to Wall Street.
They want factories and grid infrastructure, not apps. But wait, let me push back on the AI point for a second. We know China has brilliant engineers. We know they are pouring resources into artificial intelligence. Why isn't that translating into a massive US-style stock market rally for their tech sector? Are they just structurally behind in the AI race?
See, they are not behind technologically, but they are completely walled off financially. Let's look at the mechanics of the major index funds to see why. If you look at the MSCI ACWI, which is the broad index that tracks global stocks, information technology makes up a massive 26.4% of its total weight.
Okay.
But if you look at the MSCI China Index, IT makes up only 8.85%.
Wow, that is a remarkably small footprint for a country so focused on the future. So what does this all mean?
It means the gap isn't a lack of technology. Recent analysis shows Chinese AI is highly advanced. For instance, the DeepSeek V4 AI model was recently released, and it is specifically optimized to run entirely on Huawei's domestic chips, completely bypassing the need for American hardware.
Oh, wow.
Yeah, and they are rolling it out across massive domestic cloud networks as we speak.
So the tech is absolutely there. Why isn't the stock booming?
Because of the mechanics of capital flow. U.S. capital restrictions, executive orders, Treasury Department rules, they make it incredibly difficult, if not illegal, for massive American venture capital firms or institutional investors to pour billions of dollars into a Beijing-based AI company.
So it's a structural barrier.
Exactly. In the U.S., a tech company announces an AI breakthrough, and global capital floods in, driving the valuation into the stratosphere. In China, the AI breakthrough happens, but it remains within a closed, state-led ecosystem. The technology advances, but it never gets that euphoric hype premium from global investors because the global money physically cannot reach it.
It's essentially an entirely isolated microgrid. The lights are on, but it's not connected to the global power lines. So if information technology is only 8.85% of the Chinese index, what is the dead weight dragging the rest of the market down?
The anchor holding down the broader Chinese index is the consumer discretionary sector and financials. We are talking about massive e-commerce behemoths like Alibaba, platform companies like Tencent, and the big domestic banks.
And those companies rely entirely on the everyday Chinese consumer actually opening their wallet. Why is the consumer pulling back so hard when the GDP is supposedly growing at 5%?
If we connect this to the bigger picture, it's because of the mechanics of Chinese wealth. For the average American, a significant portion of wealth is tied up in the stock market through 401k accounts or pension funds.
Right.
But for the average Chinese citizen, roughly 70% of their household wealth is tied up in physical real estate. And their real estate market is currently enduring a brutal multi-year slump. Data from March shows that new home prices fell by 3.4% year over year.
Ah. So even if the government is building massive new factories and hitting their GDP targets, the average family feels significantly poorer because the value of their apartment is dropping.
Precisely.
And if you feel poorer, you aren't logging on to Alibaba to buy a new luxury watch or a high-end appliance. You just save your money.
Exactly. That consumer hesitation is devastating for companies that rely on domestic spending. Let's look at BYD, the giant Chinese electric vehicle manufacturer, as a prime case study. They recently reported a 55.4% plunge in their first quarter profits.
I actually saw that report. But wasn't that partially due to currency fluctuations? I know the Chinese yuan was relatively strong in the first quarter, which makes exporting goods more expensive for them.
A strong currency does create a headwind for exports, yes. But if you look deeper at the data, the core mechanism destroying their profit margin is a brutal domestic price war. Because the Chinese consumer is so cautious right now, they aren't buying new cars. To keep the assembly lines running and move inventory, companies like BYD are being forced to aggressively slash prices.
They are essentially trading profit for pure survival. They are bleeding margins just to maintain their market share inside China because nobody wants to spend money.
Precisely. The heavy industry is producing, but the domestic consumer isn't consuming. This is why buying a traditional, broad-based Chinese index fund is a losing strategy right now. If you just buy the broad MSCI China index, you are buying that real estate anchor. You are buying the struggling consumer.
That is a crucial insight. For the last 20 years, the standard advice for the everyday investor was simple: buy a broad emerging markets or China index funds, sit back, and ride the wave of their rising middle class. You're saying that strategy is completely obsolete.
It is entirely broken. The actionable takeaway for investors today is that you must be surgical. You cannot bet on the whole market to rise on a tide of consumer spending. If you want exposure to China's actual growth, you have to invest in the China the government is actively building, not the consumer China that foreign investors wish still existed.
Right.
That means targeting specific, policy-driven sectors like local GPU supply chains, state-backed advanced manufacturing, or alternative energy infrastructure.
You have to follow where the state bank loans are actually going.
Yes. The era of passive blind investment in foreign markets is basically over. You have to understand the specific mechanical levers pulling these distinct economies.
Which brings us perfectly back to the core theme we started with. Looking at both of these massive stories today, the realization is quite profound. We are watching the real-time fragmentation of the old global financial system.
The physical supply chains and the financial capital flows are both being, completely walled off.
For decades, the global economy functioned like one giant unified grid. We all basically agreed to trade oil in the same currency, monitor the same production quotas, and buy into the exact same global index funds. But that grid is breaking apart.
It really is.
The UAE is ripping up the rulebook on oil pricing to secure their own autonomous future. China is engineering an entirely proprietary state-funded tech ecosystem that doesn't need or even want Western capital.
And that means the tools investors used for the last 20 years need to be fundamentally reevaluated.
It really leaves you with a critical question to ponder. As these structural walls go up across the globe, are we witnessing the permanent end of the one-size-fits-all global index fund era? I mean, If the world is breaking into isolated microgrids, your portfolio probably can't rely on a single global strategy anymore. That is definitely something to mull over as you review your own investments this quarter. Well, that is all the time we have for today's deep dive. Don't forget to subscribe and hit that like button